Welcome, everyone. We're glad you could join us for today's Thought Center webcast. These webcasts are a series of live, interactive events featuring EY's thought leaders. Today, we will explore the extensive state and local employment tax trends in 2018. I'm Ken Hauser, Executive Director of Employment Tax Services, and I'm thrilled to be today's moderator. Before I introduce today's agenda, I want to let you know you will have the ability on your desktop to send your comments and questions to us. We will try to get as many as we can during our limited time today. We will have polling questions appear throughout this webcast. You'll need to respond to them in order to qualify for CPE or CE credit. So if education credits are important to you, please keep an eye on your screen for these polls during the course of this webcast. If you are a CPP or FPC, you will need to answer polling questions throughout the webcast in addition to a specific polling question towards the end of this webcast in order to qualify for RCH credit. If you respond yes to the RCH polling question, your certificate will be emailed to you within 2 weeks. Be certain to download a copy of today's slide deck by clicking on the green resources list icon. Before we start our discussion, let's review today's agenda. To begin with, we'll kick off with the 2017 Multistate Compliance Survey. We are thrilled to have Michael Baer of Bloomberg Tax here with us again. He's the managing editor of the Payroll Library. Debbie Salam will be helping him through that section. Next, we'll turn to Pete Berard, who will take us through state's response to tax reform. Pete will turn it back to Debbie, who will take us through some other state payroll tax trends. And last but not least, we will end with Ray Grove, who will cover state information reporting and withholding. Michael and Debbie, thanks for kicking us off.
All right, thank you very much, Ken, and it's always a pleasure being here with my esteemed colleagues at E&Y. And we're going to have some fun with numbers to start off, dealing with the 2017 Multi-State Compliance Survey results. It's a joint effort by EY and Bloomberg Tax to put out a survey that we did at the end of last year related to all the issues surrounding multi-state income tax and payroll income tax compliance. And the focus, of course, as you saw in the video, is audit activity, but there were a lot of other numbers that we're going to talk about, and we're going to try to get through these quickly and spare you some of the details, but you'll have them there in your slides. So first of all, you can look at the demographics here on this slide. We had a nice mix of respondents. We had 468 respondents. We had 28% had fewer than 1,000 employees, but 72% had more than 1,000 or 1,000 or more. I want to talk quickly about industry representation here and what these terms are: nonprofit, not public sector. So generally, non-business operations include government entities, membership organizations and associations, healthcare facilities, and the like, educational institutions. Manufacturing is pretty much, you can understand what manufacturing sector is, and non-manufacturing is basically everything else. So I wanted to say, Debbie, we were pleased with the response this year, right? I mean, you had noticed this year compared to the previous year, we had more respondents. Is that right?
Yeah, that's right. It was fantastic. So we pulled in 468 responses, so that was quite a bit better than the previous year. So we were really happy to see that.
The first thing that we want to talk to you all about is how are payroll systems performing when it deals with multi-state workers and employees that traverse over different jurisdictions. And a lot of the respondents said, hey, 71%, it is adequate, but a sizable minority, and if you add them up, there's 21% not adequate, 8% don't know, which is really scary. 29% really kind of self-admitted that there's some exposure here. They're not doing what they feel is appropriate to cover themselves for compliance purposes in the multi-state area. And local tax support, even it diminishes even further the confidence. And you can see here by industry, with the industry sector that seems to have the most difficulty getting their arms around this is manufacturing. And Debbie, you had some comments on this issue as well.
Yeah, I wanted to go back to this, the local jurisdictions with folks feeling that their payroll systems aren't adequate. And I think this really points to needing to dip into newer technologies like geocoding. So I think the biggest issue here is just understanding exactly where do your employees live and work and what are the taxing requirements in those areas. And this is where we find that a lot of companies have issues, even with automated payroll systems. So we're going to talk about it at the end when we go through next steps of a little bit more about geocoding type technologies that can augment the payroll system and help a little bit with that pressure.
Right, and we did measure the tracking, how employers track, and there is a slide on that that we'll get to pretty quickly. So next, the next question that we want to provide some stats for is how do payroll professionals keep abreast of requirements and changes? And the respondents said, hey, first of all, about half use third parties to help administer multi-state payroll issues. And certainly there's a little bit more on the 1,000 or more employee area. And then the second area, of course, that's really critical is what kind of resources are being used to keep track of these rule changes and these changes that affect compliance. And one thing Debbie and you and I were talking about earlier was that you could see professional publishers. Obviously, that's what we do. But third-party tax advisors, payroll organizations, certainly the American Payroll Association. Kind of scary to see that 3% don't use, admitted that they don't really use anything. But these sources, one thing is that it's critical that you have multiple sources. And why is that? Debbie and I were discussing it. You know, they might not all line up, and there might be some issues that there might be some distinctions that need to be made that are not being made in one source or another. So, Debbie, did you care to comment on that?
Yeah, that's right, Mike, and I think we really learned this during tax reform. Whenever you have any major piece of legislation like that, of course, everybody wants to be first and out there getting people the information. Well, that was a complicated piece of legislation. So here's where you really benefited from having more than one source reporting on that. Remember the go-around with the law says the supplemental rate's 28%. So technically that's what it is, but people more experienced with dealing with that legislation said, that wasn't the intent and it probably won't happen that way. So again, it was good to see the respondents obviously showing that most of them do rely on more than one source to keep track of what's going on. So that was certainly a takeaway and a lesson to learn there.
That's right. Okay. And then moving on to a third piece that we're going to present to you, and there's a couple slides on this, is what was referred to in the video that started the program, the audit activity. And this is so key, such a key metric here that we brought out of the survey results, is that first of all, large employers overall seem to be more likely to be subject to audit. I think there could be some obvious reasons to that and some maybe not so obvious. There's also, if you're looking at some of these numbers here, unemployment insurance tax. For audits for unemployment insurance tax, we're talking well over 4 out of 10 of the respondents have had unemployment insurance tax audits. And look at the numbers for the others. The state income taxes, more than 1 out of 4. More than 1 out of 4. And then for non-manufacturing, which is our biggest set of respondents, fully a third of them said that they had been subject to state income tax audit for multi-state issues. So it appears to me that there is a lot of activity happening. And one of the things that we look at as well is, what's the likelihood of a federal tax audit for employment taxes versus maybe the state and local and unemployment insurance tax? And it appears to me that these survey respondents seem to be more likely to get audited for state and local than even for a federal. Debbie, do you have any comments on this slide?
Yeah, that's right, Mike. And the other thing I want to point out is these numbers went up between 2017 and 2016. So more respondents reporting that they've been subject to an income tax withholding or unemployment insurance audit.
Right, and that's demonstrated in the next slide. Actually, if you look in it, if you all have copies of these slides, so you'll be able to see here. Look at the uptick in the numbers. Just in the last year, we're seeing a 22% versus 15% reporting that they've been audited for unemployment insurance 2 to 3 years ago. 22% just in the last year, and you could see the state tax. It bumped up last 2 to 3 years. There seems to be a much higher incidence of being audited for state income tax issues. Deb, do you?
And the other thing is very interesting to note is unemployment insurance. Surprising, but we're seeing a lot of audits for unemployment insurance. So who would have thought it? And I think the next slide, the next couple of slides will emphasize that even more.
Right. So moving on to, okay, what if you're present, you have presence in certain states, what are the likelihood of these, are you more likely in New York to be audited for state income tax withholding than any other state? Yes, that's true. And you could see here that New York is definitely the highest. 53% of the respondents reported being audited for state income tax withholding in New York. That's up from 47% in 2016. You could see the list there of the other states. And why don't we move on to the next slide for state unemployment insurance audits, and we could talk about what Debbie was just mentioning, that we have the state unemployment insurance audits in New York and California are kind of neck and neck in that category in terms of the numbers of respondents that said, hey, I've had a California state unemployment insurance audit.
Yeah, those two are competing for first place.
Yeah, they are.
California and New York.
Yeah.
Not surprising, though, at all.
No, but you could see here in the unemployment area, some states that do not have income tax. Florida is number 3. Texas is number 6 in this list. So they start getting in Washington tied for number, I guess, 5 or 6 in that. So they're starting to get into the game there on the auditing as well on that unemployment insurance side. So let's move on to one of the biggest issues that we uncovered in this survey was some of the problems with communicating interdepartmental of the whereabouts of these employees. And you just need there's evidence of multi-state problems that start at the assignment of the employee or the dispatch of an employee to a different jurisdiction. And it's because they're just not getting a timely communication and these other issues here that you could see on the slide. And Debbie, you wanted to talk a bit about this too, and about the communication issue.
Yeah, and just, what you said, Mike, is a lot of the issues that we're finding, which result in those W-2Cs at the end of the year. So 80% of respondents said, wow, yeah, we have W-2Cs that are directly tied to multi-state reporting issues. And a lot of it stems from not getting that timely notification about, an employee's change in a work state, the trailing compensation issue, not having historical data, going back and sourcing from the date earned. 47%, that's almost half, have that issue. And then last, if you have international payroll, failing to get that Form 8233, when that non-resident aliens claiming a treaty exemption, 22% had that issue. You can read more about this observation if you click on the link, which you can get when you download the handouts on the green icon tab.
Okay, and then to follow on with that, we talked earlier about tracking, and this next slide talks. We did ask the question of them of the respondents. Hey, so how are you keeping up with the employee movements over jurisdictions? And It's really a hodgepodge of answers here. And most of them are really imperfect at best, and they're after the fact. They're finding out about exposure after the fact, and then having to kind of go back and repair. And that can be an issue. And then another issue here in the other two sections of that slide it relates to employers saying, okay, we want to comply, but it's too administratively difficult to comply completely on the first day. But you're not fully compliant, and you could be exposed. And the same thing with the whether you choose a certain segment of the employee population to comply fully with, and just kind of hedge your bets on the rest of them. This might not be, Debbie, the way to go in the future, in the near future, as more technology comes into play in the audit fields.
Yeah, that's right, Mike. And the other thing, too, is if you're not complying everywhere, meaning you're just choosing populations where you're going to comply, do remember if you're publicly traded, you do need to still measure what your penalty risk is and your withholding liability risk, and you need to accrue for that and book that as a reserve. So even though you're not doing it, you still have to measure it. So do keep that in mind as well.
And courtesy withholding can be an exposure issue. And I just want to refer people. I know E&Y we have the survey results related to that, but we're going to need to move on here. I want to refer people to this slide. Deb, did you want to say a word or two about this before we go to the next?
Yeah, I just want to let people know in the resource section of the handouts, we do have a special report on courtesy withholding, and we do encourage everybody to read that report. It's very important.
Okay, and I thank you all. I think we have a polling question coming up next.
Yeah, and before we go there, Mike, I did want to mention that you notice that we don't have a multi-state compliance survey for this year, and that's because we felt that we needed to give it a pause for a couple of years and start to get more historical data gathered before we launch that survey again. What we'd like to do instead is to next year open up a survey on some different topics. And in order to do that, we'd like to hear from you. I know you're always curious what are other businesses doing, so let us know what would you like included in our next survey. And you can do that by entering a topic into the polling question result. Do keep in mind, if you want your CPA or RCH credit and you can't not think of the topic, you'll need to type none in order to get credit for this polling result. So we'll tune in on that again next June. We'll be back, and we'll unleash the next survey based on your feedback. Thank you so much.
Thank you, Michael and Debbie. And I think very interesting results on the unemployment audits. I think with the gig economy becoming more and more popular, and workers and employers alike leaning towards a relationship that's on a contractor status rather than employee-employer, I can't imagine that those issues and those audits will just continue to increase. So without further ado, we'd like to turn it over to Pete Berard to talk through some other state issues. Thank you.
All right. Good afternoon, everyone. Jumping right in, we're going to be talking about some state income tax issues and some Forms W-4 updates. In Colorado, the Department of Revenue has recently revised its income tax withholding tables in response to the passage of the Federal Tax Cuts and Jobs Act. This was done in late March. Those changes are in effect for April 1st, 2018 and forward, so there's no need to make any changes retroactively to the end of the year. The department has advised that even though there has been the adjustment in these withholding tables, that if your federal income does go up as a result of the passage of the tax law, your Colorado state tax liability could also go up. The state tax rate of 6.3%, both the income tax withholding and the supplemental wage rate are remaining the same. And we do expect that there will be an update to the tables again in January of 2019. In Georgia, under House Bill 918 that was effective at the beginning of next year, corporate income tax rate and the highest individual income tax rate, which are currently both at 6%, will decrease to 5.75%. For years beginning on or after January 1st of 2020, there is the ability for the rate to drop down to 5.5%. However, in order to do so, there will have to be an approval by the legislature, and the governor will have to sign a joint resolution ratifying that additional rate reduction. As of January 1st, 2026, the corporate income tax rate and the highest income tax rate for individuals will revert back to 6%. For the years of 2018 through December 31st of 2025, the individual standard deduction has been increased, and that for years beginning on or after January 1st, 2017, the law updates Georgia's Internal Revenue Code conformity date to February 9th, 2018, with some corporate income tax exceptions. We also expect there to be some updated 2018 state income tax withholding tables later this year, as well as for next year to reflect the reduction in the income tax rate. Moving along to Idaho, the State Tax Commission has released on its website a revised version of a guide to Idaho income tax withholding that was revised at the end of April. So it contains the new 2018 state withholding tables and reflects a reduction in income tax rates. The supplemental withholding rate has decreased to 6.925%, down from 7.4%, and that there is no need to do any retroactive withholding back to the beginning of 2018. The Commission does recommend that all employees update their federal forms W-4 for state withholding purposes, and Idaho now uses an Idaho allowance count on federal form W-4 line 5, and there is an example of that in the revised withholding tax guide, that essentially the Idaho withholding allowances are based on the number of children who qualify for the Idaho Child Tax Credit. In Kentucky, the Department of Revenue released their revised 2018 withholding tables and computer formula in response to the passage of the Tax Cuts and Jobs Act, and also their recently enacted legislation has replaced the graduated personal income tax and corporate income tax with a flat income tax rate of 5%. As with other states that I've mentioned before, the employers are not required to go back and adjust withholding, but should use these new rates and tables and formulas as of January 1st, 2018. Also effective for years on or after January 1st, 2018, there are no longer withholding tax exemptions allowed in Kentucky, and the Form K-4, the Kentucky Employees Withholding Exemption Certificate, will no longer apply. In Oklahoma, they have introduced a new state withholding allowance certificate, the Form OK-W4, in response to the passage of the Tax Cuts and Jobs Act. The new form should be used by new employees and any employee who wishes to make changes to their Oklahoma state income tax withholding after February 28th of 2018. The use of the federal form is no longer allowed, which had been the historic practice. However, with the implementation of the Tax Cuts and Jobs Act, the agency has determined that a state-specific form would be best for their taxpayers. In Utah, there has been some revised tax tables. House Bill 293 reduces the state income tax rate from 5% to 4.95%, retroactively back to January 1st, 2018. The same reduction also applies to the corporate income tax rate. The revised withholding tables that were issued will apply to wages that are paid on or after May 1st of 2018. No need to go back to retroactively adjust, and that also if taxpayers are interested in learning how their Utah income tax liability will change in 2018, the Tax Commission has created a state income tax estimator on its website, which you can click the link in our slides and it'll take you to there. In terms of income tax reporting, employers are now required to file quarterly returns electronically through the State Commission's TAP site, the Taxpayer Access Point. And beginning with the 2018 tax year, employers will not file a separate annual reconciliation return with their W-2s. Instead, the reconciliation will be combined with the employer's fourth quarter return for quarterly filers, much like has been the practice in New York State, or on an annual return for your annual filers. So the new form is the TC 941E, which is due each year on January 31st. And we have a link there to get to the instructions for that particular form. Now, on our next slide here, we have a nice graphic that I know that Debbie had some comments on with regard to when a separate state W-4 is required. As I'd mentioned in some of my previous slides, there have been some updates for Kentucky and Oklahoma. But Debbie, I know you had some comments.
Yeah, Pete, with the Tax Reform Act, we know that we're going to be seeing a lot more activity here. So, Oklahoma and Kentucky were the first ones to show up. But the IRS, of course, did not implement the personal exemption deduction change on the 2018 Form W-4. I expect they're going to do more changes next year. So this is something where employers really have to watch what's going on. So we expect this map to change, either more states detaching from the Form W-4 or like Kentucky not looking at those personal exemptions anymore. So that's a big trend to watch.
Thanks, Debbie. And I think from what I've seen, I don't think we've heard the last of either retroactive or prospective withholding rate changes here. So let's keep our eyes and ears open. And that actually will take us to our next polling question. Do you provide communications to employees notifying them of state or local income tax withholding changes, e.g. revised withholding rates or Form W-4 changes? As you're thinking through that question, we're actually going to turn to another state here and see how New York has responded to tax reform in a very aggressive manner. So, Pete?
Okay. Thanks, Ken. In New York, as most folks have probably heard, I know that we've issued some alerts on it, and certainly been a lot of discussion in our office about it in the past several weeks. But New York had passed some legislation earlier this year that includes a provision that allows for an optional employer compensation expense tax, the ECT for short. And essentially the aim is to protect New York individual income taxpayers from increased federal income taxes as a result of the $10,000 cap that's been placed on state and local tax deductions under the Tax Cuts and Jobs Act. Now, how it works is that if an employer opts to pay the ECT for its covered employees, then those individuals will receive a tax credit against their New York personal income tax liability. The ECT is paid only by the employer, and the tax credit received by the employees is not necessarily dollar for dollar. It will go into an example of that. Just a few more terms that we just wanted to go through first. In terms of payroll expense, that's essentially the wages and compensation that are paid and that are defined under Internal Revenue Code sections 3121 and 3231, paid to all the covered employees. That essentially they are their Medicare wages for those individuals. As I mentioned before, there is no deduction that is permitted from the compensation of the employees for electing employers. Just some other basic definitions here. An employer is essentially an employer that's required to deduct and withhold tax from wages under New York tax law, section 671. And an electing employer is an employer that has made the annual election to be subject to the ECT. That election must be made by December 1st of each calendar year. If that election is missed, say the election is made on, for example, December 2nd, then the election would go into place the second succeeding calendar year. So essentially when opting in, the annual election must be made by, if the employer is not a corporation, by any member, owner, or other individual with authority to bind the entity or sign returns as required pursuant to New York tax law, or if the employer is a for-profit or not-for-profit corporation, by any officer or manager of the employer who is authorized under the law of the state of New York, under the law of the state where the corporation is incorporated, or under the employer's organizational documents to make the election, and who represent to have such an authorization under penalties of perjury. As I mentioned, this election must be made by December 1st of each year for the next succeeding year. In terms of the tax rate, this tax is being phased in over the course of 3 years. So for the calendar year 2019, the rate for each quarter of 2019 is 1.5%. For 2020, that rate is doubled to 3%, and for 2021 and thereafter, the rate goes up to 5% of the payroll expense paid to those covered employees. Now, the electing employer is only subject to the tax on the payroll expense that's paid to these covered employees during the calendar year in excess of $40,000. Now, the ECET is required to be paid at the same time the electing employer is required to remit payments under New York tax law, section 674, talking about withholding on payroll with certain exceptions. Additionally, the Commissioner has the ability to require that ECET forms and returns be filed electronically, all payments be made electronically, and that they do have discretion over the methodology of quarterly filings, including possible specific employee level details. So things remain to be seen with that particular issue, as currently there is no regulations or administrative publications, but we certainly do expect some in the near future as a result of a quip that was put in some guidance from New York over the past couple of weeks. So we do expect some additional guidance. As I mentioned, in terms of the calculations for the ECET tax that's due and the credit, starting first on the right hand of our slide here, the ECET due is the payroll expense, as I mentioned before, in excess of $40,000 per covered employee, multiplied by the ECET tax rate. So in our example here, Mike's employer paid him $5 million in Medicare wages during calendar year 2019. So the ECET due for that particular year is $5 million less $40,000 multiplied by the introductory rate in 2019 of 1.5%, yielding an ECET tax due of $74,000. Now going over to the income tax credit, it's the calculation for that is generally the same, except you're multiplying what would be more or less the ECET due by a number that is one less a fraction of the individual's New York personal income tax before credits divided by New York taxable income of the employee. So I know that looks like a lot on the page there, but seeing it in the form of an example will certainly help understanding. So as we mentioned, Mike, the covered employer in our previous example, he's paid $5 million in New York wages in 2019, and he has no other taxable income. So his personal income tax before credits is $475,000. So his credit is $5 million less $40,000 multiplied by 1.5%, and then we're multiplying that times 1 less $475,000, his tax before credits, divided by $5 million, his taxable income. That yields a tax credit of $67,332. So as you can see, the tax paid does not necessarily yield a dollar for dollar credit for each individual. Now this particular tax has certainly opened the door to a lot of questions, and a lot of things still remain to be seen with regard to these taxes. So some of the things that we have listed here that we've discussed internally in our offices as well as with some of our clients are, how will the IRS address the ECET? So that certainly remains to be seen, but based upon some recent guidance that the IRS has issued in terms of notice, granted it was not specific to the ECET, it certainly sounds as though the IRS will not necessarily accept any of the workarounds that are being put into place in a number of states with regard to the Tax Cuts and Jobs Act. Also, Secretary Mnuchin has made some similar comments to that regard over the past few weeks. Another topic here that we've talked about is that when you have a New York-based employee but who reside in other states, will those states, those resident states, allow the taxpayers to include the ECET credit funded by their employer as a credit for taxes paid in other states on their individual income tax return? Now, Connecticut has said informally at a recent conference that they are considering a tax credit for Connecticut wage earners in New York with the possible establishment of a reciprocal convenience of the employer test so that its residents who are working in any states with a similar payroll tax system to the ECET will benefit. Some other issues are in terms of tax, the funding of the tax itself. New York has certainly hinted that the ECET can be taken from future compensation increases, although that is definitely not specifically written in there. It does sort of allude to that. So it also states that, as I mentioned before, that the tax cannot be deducted from an employee's pay. So some of the things that we see are maybe is there an argument that withholding it from future compensation increases, is that essentially deducting it from an employee's pay, and does that raise any employment law or labor law issues? Also, there is a question in terms of whether the payment of this tax that the employee ultimately benefits from on a return is whether this represents imputed income to the individual. So that's something else that is open. And also we have discussed here about if you have someone who periodically works in New York, how does that work in terms of the amount of ECET that's paid versus the credit that someone receives. Right now, the way the law is written, it does not necessarily say that there is an allocation of wages to New York State. It's very much defined like the MCTMT tax in New York, that payroll expense is your Medicare wages. However, there's no discussion of allocation. We'll have to see if there's any additional information on that we receive from New York State. Just a few other things we have listed on this last slide here in terms of considerations for PEOs who make that election. We would tend to think it would be the individual employers, but it is something that has been raised in some of our discussions. Companies who could potentially restructure their businesses to take advantage of the ECET tax, so that essentially employees that will not elect will be in one entity, those that want to elect will be in another entity. Issues in terms of how the credit carry forward is calculated on someone's individual return, if one spouse is working for an electing employer and one is not. And also another interesting item that one of my coworkers had come up with was, what if you're working for the same company in another state that doesn't have this sort of I guess considered a benefit, your employer funded tax credit? How are those individuals in those states going to feel? So there's potentially some HR complexities here as well.
Thank you, Pete. I think one of the common questions I'm seeing coming through is what companies or would companies elect to do this? And I think from our client experiences, most companies are leaning towards not doing this. However, based on certain fact patterns, we've seen some brokerage firms with a small number of folks that sit mainly in New York and very high wage earners, 10, 12 employees, where they're pretty excited about this. So that's been our experience to date on this topic.
Right.
With that said, we have our third polling question. Are you considering electing into the New York Employer Compensation Expense Tax, yes or no? Debbie, I think you can take us over to the next topic, which is additional state payroll tax trends.
Yep, thank you. So I'm going to do a real quick tour through this. Again, everybody keep in mind on the green resource icon, you can download today's materials where you can look at these things in a little bit more detail. Okay, so let's talk first about unemployment insurance. Here we have a graphic, and you can see that we have some pretty high wage bases. You can tell by the heat map. Most of the high wage bases are concentrated on the West Coast and a little bit on the East Coast. And keep in mind, too, that where you see the little blue dot, these are states that automatically adjust their wage bases every year. Now, while this does look daunting, I do want to say the overall trends for this year are very positive. We're seeing historic reductions in tax rates and wage bases. So I believe that's owing to an improved economy. And we'll be sending out some more details about that in the next couple of months. But overall, that is looking very positive. On another positive note, the few to credit reduction states, there have been only 2 for the last couple of years, so we've really whittled that down. California just repaid its federal loan balance, and if it continues to maintain that zero balance through November 10th, we'll only have Virgin Islands as a few to credit reduction territory for 2018. So that's also positive. Now, there's some trends we want to be keeping an eye on, and I believe as we get closer to the 2020 elections, as some lawmakers probably want to look a little bit more popular with voters to gain re-election, we're going to see these trends increase. One of them is state payroll taxes for health care. Now, right now, there's only 2 states that have that type of a tax, Massachusetts and Vermont, but there are 3 states to look for, actually 4, that have something pending. So here you can see that on the heat map. If you click on those states, you can read the pending legislation. In Washington, it's actually a ballot initiative that will come up this November. So this, again, something that we expect to increase and increase complexity at the same time. Another trend, which again is also largely in the progressive states, as you can see on this heat map, are states that require paid family and medical leave insurance. Again, Washington's law takes effect in 2019, but this is something that the Trump administration would like to incorporate into a federal law that would basically require all the states to administer this program through the state unemployment insurance agencies. We do have a special report. You can click there to download it that does caution you about the complexity around the tax treatment. This is not tax like disability pay. So just a key warning there. Moving on to another trend are states that mandate retirement savings plans. Here again, we see this is again something from the progressive states. Probably not an issue for large employers that already have a 401k, but for a smaller employer that does not, you want to watch for this legislation, which basically says the employee can enroll in a state-sponsored plan and the employer must accommodate the payroll deduction for the state plan participation. The Trump administration did remove some executive orders that makes this a little more difficult for states to move forward with, but nonetheless they are moving forward. Now, the rest of the stuff I'm going to talk about are just other revenue raisers that have come up. I won't get into a lot of detail. You can read those in the handout. But the Connecticut telecommuter income tax is a recent development. So if you have people who report to you in Connecticut and they're working from home, look out, effective in 2019. There's some new rules there. And in Maine, there's a home health care payroll tax ballot initiative. We've alluded to that previously. You can see more details about that. We'll see how voters do with that in November. In Oregon, we have implemented this year the new Oregon State Transit Tax and Reporting requirement. This is, again, to fund Oregon's highways. And here you can click on the handout and you can see all of the new forms and all of the requirements for remitting and paying that tax. Finally, in Washington, this one is wild. As you guys know, we told you last year that Seattle tried to impose an income tax. Washington has a constitution against income tax. The state does. So, of course, the courts basically shut that down. So what they came up with instead is a head tax. So this is a tax that businesses have to pay. And this, again, will start in 2019. Again, without getting into the details, this one is more likely to stick because it's a head tax and not a tax on income. There is a state senator, Mark Schnolster, who has introduced a bill already to basically ban localities from passing head taxes, and if that gets enacted, it would be retroactive to January 1, 2019, and would defeat the Seattle tax. So we want, and by the way, this tax is to fund shelters for the homeless, so that's the purpose for that tax. So a lot going on and a lot to watch for. And with that, Ken, I'll turn it back over to you for a polling question.
Thank you, Debbie. And before we get to the last polling question, we do have the results from the first, the second, and third question. Do you provide communications to employees about W-4 changes at the state and local level? 45% said yes, 40% no, and 15% are thinking about it. And this one, hot off the press, which many of you are actually asking about, is are you considering electing into the New York ECT tax? So only 14% said yes. The majority were no. So it's pretty similar to what Pete and I have seen with the companies that we're speaking to about this as well. So polling question 4, there is one more. There is a polling question 5 for those that need RCH. Please make sure you stay on and answer that one. But for question 4, have you reduced or eliminated transportation fringe benefits in light of the Tax Cuts and Jobs Act? Yes or no? With that, our final speaker, Ray Grove, will take us through state information reporting and some things he's seeing right now.
Thank you very much. So we're going to start right away by talking about Connecticut and a new change around pension and annuity withholding. Moving forward here, effective January 1, 2018, businesses are actually required to withhold on state income tax for pension annuities. So this is generally going to be payments that would land on a 1099-R form. That's going to include things like pension and annuity payments, profit sharing plans, stock bonuses, deferred compensation, really all of those types of payments. And that's something that, lots of other states also have a requirement, and we're starting to see a little bit more of a trend. And, Mike, I know you, in speaking with you, you had some comments on this that you wanted to throw in as it relates to this new requirement.
Yeah, Ray, it definitely is a trend. I think, Connecticut is one of the later states to come on, but we do list 9 states that have that requirement, and plus D.C. and Puerto Rico. And what's happening is that the systems being used to collect the taxes are identical or similar to what the payroll systems are needed for collecting and remitting and reporting on the taxes. So this is why there's kind of like this nexus into payroll, because essentially this is the withholding just like wages, except it's on retirement benefits. And so certain accounting systems might not be set up for that totally, but they should be, because it's always been kind of voluntary in there, but now these states are making it required. And Connecticut is just one of the more recent examples of that.
Yeah, thank you. Yeah, it's important to note that, outside of even the required states that you just mentioned, there are lots of states that have the voluntary withholding, and keeping track of that and how you're properly reporting and remitting that is always an important thing. There's also other state updates. So I know for a lot of the folks that are participating in this call, you may not be as familiar with some of the 1099 reporting obligations that you may be doing at your organization, but there's other expansions in some of these requirements as well. For instance, we see in Alabama and Vermont changes to things like 1099K reporting. One of the more interesting things, and this is oftentimes true, if you look at Vermont, the reportable amount of income is actually anything that is equal to or exceeds $600 per person, which is very different, from the federal threshold being $20,000. So, for a lot of this, the states are starting to look at these non-wage income streams that individuals have, and really trying to focus on, how is it that we get this information and make sure that people are actually, filing them tax returns within our states, and that all income that they're making is being reported, including the non-wage. For instance, you see Iowa there now requiring the 1099 and W-2G reporting with them. If you go to kind of one of the more other recent examples with Pennsylvania, we also see a pretty broad sweeping requirement. And, for a while they've had requirements around reporting really focused on the energy sector with lease payments, but now all non-wage income is actually withholdable for any individual who is not a Pennsylvania resident that is performing work within the Commonwealth. And the challenge is, as we were talking about earlier, is for a lot of organizations, there's issues with systems and the ability to track and having the right tools and technology and people focusing on it. Whether or not it sits within payroll or sits within accounts payable, how are you talking to your counterparts within those groups is something that many people struggle with. So when you kind of move on and look to focus on what are the things that I need to be thinking about, there's obviously understanding what your withholding obligations are within your organization. How does that line up with your, the tools that you have today? Are you tracking these new changing regulations and obligations? How are you, from a withholding perspective, making sure that you're following the proper schedules to make those withholding payments? Do you have the right people to do the work? And how do you close the gap from where you sit today and where you need to be? And the one thing I would recommend to everybody here, when you start thinking about a lot of this, is talk to your counterparts over in AP, because it's generally going to take a bit of a team effort of understanding what everybody's doing and making sure that you have the processes and things in place to be able to get the work done.
Thank you, Ray. I think, in light of what's happened in Pennsylvania, I can't imagine them not doing some sort of enforcement to what the new rules are. And states, as they continue to maybe reduce both corporate income tax and or state withholding, as we saw earlier in the presentation, maybe looking for other ways to bring in revenue to the states. So I would not be surprised if the other states kind of piggyback on what Pennsylvania's rules that just came out. So we'll keep our eyes open for that. On to polling question. Before we go to polling question number 5, we do have the results from number 4. Have you reduced or eliminated transportation fringe benefits in light of the Tax Cuts and Jobs Act? 14% said yes, 71% said no, and 15% said we are still discussing it. The last and final polling question, especially for those that need RCH credit, please answer that one. And as you're answering that question, I will turn it back to Debbie for some next steps.
Thanks a lot, Ken. And I do want to tell everybody, if you're looking for RCH credits out there, do not miss this polling question. You need to say yes, and you'll get your RCH certificates in 2 weeks from today. All right, so let's talk about some next steps. We've talked about an awful lot and hit on a lot of subjects today, but I think it's important to regroup and say, okay, in summary, what do we need to be doing? Number one, I think it's very important to consider supplemental Form W-2 statements that will break down wages actually earned in each work state. Now, why is this important? Well, first, we have states like New York who require that your Box 16 always equal Box 1. And that can really create issues for people trying to fill out their individual state income tax returns. But also because of the tax reform and the fact that states may or may not conform with all of the new changes in miscellaneous deductions and all of those things. So I think it's very important, again, to consider that you are offering a supplemental statement that shows the wages actually earned in each state, particularly, again, for those employees who work across multiple states. The second step, provide employees with annual relocation expense statements. And this is really important because, again, the Tax Reform Act disallowed the moving expense deduction and then also requires that employers tax it if they reimburse it. But we're already seeing differences in states not conforming to that rule. For instance, New York, in the recent budget bill that they passed, New York does not conform to the moving expense change. So again, so that employees can be sure to take advantage of any state differences, do consider, again, a relocation expense statement that tells employees items that they can claim on their state income tax returns. We've talked about a lot of changes already that have happened in State Form W-4 rules, withholding allowance tables, and all of those things. So this year it's really important, if you're not already doing it, give your employees notices about changes in state and local withholding rules, any rules about new withholding allowance forms that need to be used. Consider, for instance, putting a notice in your pay stub. There are some vendors that do give you that capability of customizing the pay stub, or consider giving them a separate mailing. We did learn in our last webcast around the topic of communication, about half of the respondents to those polling questions indicated that they are now, because of tax reform, communicating with employees. Step 4, develop a monitoring system for tracking local, statutory, and regulatory payroll and benefits changes. Again, we've talked about this in the survey. Many of you are using multiple sources, but it's not enough to read the news. You need to have a formal system. So we have some clients, for instance, that take a news item and they post it to an actionable folder where it's set up in a work stream for tracking, making sure that the system has been configured or updated to include the change or any other procedural things around those changes. The next one, geocoding software, and we did talk about this earlier as well. We find so many errors in companies around the local tax, even some of the state tax requirements, because they don't have an efficient way of looking at an employee's work address and resident address and then automatically seeing a list of all of the tax obligations that apply based on those addresses. And this is where any type of a geocoding type application can be a great help in doing better on future audits, as we see those are increasing. In the 7th step, review your payroll system earnings and deduction codes. This is always important to do every year, but especially now with these federal changes and various state changes, making sure that earnings and deduction codes are properly configured for income tax and unemployment insurance. Lastly, very important to investigate the benefits of an electronic W-4 system. Again, there's a lot of providers out there who always make sure to keep the latest certificates on file. Employees can easily access the information. Again, you don't have to worry about holding on to a lot of paper documents either because they're nice and securely stored in a nice online system. So again, with all of the changes happening and states decoupling from use of the federal Form W-4, that's probably something to consider if you're not already using it. I would like to talk a little bit about resources. In your handout, you will see and you'll be able to click on all of our special reports that we have available to you. We do commit to always giving you a special report whenever we see a trend, a new topic, or there's a lot of questions, and those are available to you here. Our latest report, 6 Tips on Summer Employment, is posted to the green icon where you can download that special report as well. So with that, Ken, I'll turn it back over to you for questions and comments.
Thank you, Debbie. I think to echo your comments, changes are coming, so we need to keep abreast of state and local changes, whether it's through tax reform or increase in audits. The states and local governments are using technology to really look for ways to increase revenue, so we'll have to keep abreast of these changes. That's going to wrap up our discussion for today, but before I do, let me remind you to click on the green resources list icon at the bottom of your screen and download today's handout file and other related material. On behalf of everyone at EY Workforce Services, I'd like to thank you and our audience for joining today. The archive of today's program will be posted on the Thought Center webcast homepage in about a week. This is also where you can view many of our other webcasts. And if you have been with us for at least 50 minutes, responded to the polling questions, and if you also complete the feedback, you can now download your education certificate by clicking on the CPE icon at the bottom of the interface. For CPPs and FPCs needing RCH credit, we will email your certificate provided you answer the required polling questions. We will definitely pay attention to your feedback, so before you head off, please take a moment to open up the red feedback icon and let us know what you thought of today's program. Thanks for listening.